Adobe reported quarterly financial results that showed surpassing remaining performance obligations above $20 billion. That was some good news for Adobe stock investors, and of course, I'm happy about that. I've had Adobe stock rated as a buy all year long in 2025. I've had it rated as a buy for longer than that. So in this video, I'll review the company's latest results. I'll share with you my updated fair value calculation for Adobe that had the intrinsic value increasing, and I'll update my recommendation and let you know if I still think this stock is a buy after these quarterly financial results.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
Right, so Adobe reported that AI first annual recurring revenue already exceeded their $250 million year-end target. And that's particularly important for Adobe stock investors because one of the reasons why this stock has been trading so cheaply is because investors are concerned with all the AI innovators coming in its category and taking market share. So Adobe is pleased to once again increase their fiscal year 2025 revenue and earnings per share target after yet another quarter of better than expected performance from the company. Adobe achieved record revenue of $6 billion in the third quarter of 2025, representing 11% year-over-year growth. The company's cash flow from operations came in at $2.2 billion, and this is one of the reasons why I've liked this business for as long as I've liked this business. If you divide the cash flow from operations to the company's revenue, $2.2 billion divided by $6 billion, you'll notice that the cash flow from operations to sales ratio is above 33%. That's a strong number. The company generates a strong percentage of its revenue as cash flow, and it's an opportunity, I believe, to compete against these new innovators that are coming in the category. Adobe has a large budget. It can allocate more to research and development to create and withstand this surge from competitors by creating its own innovations, by creating new products and services that aim to serve customers in this category. Adobe in the quarter repurchased 8 million shares, and you have probably heard me say that I like when companies repurchase shares because it shows me that the management team thinks the stock is undervalued, and all of that is true. But there are some cases, like in this case here with Adobe, where a company is facing a threat to its business as a result of new technology or new innovation or new competition. And in those cases, I would really like to see management teams spend more money on reinvesting into the business, specifically to address certain needs. And for Adobe, I think the need here is in research and development, in creating new products and services or enhancing existing products and services to withstand these new threats. And this is one of those cases where I would like to see Adobe's management team find categories they can increase investment into the business. So the new outlook for fiscal year 2025 has the business generating about $23.7 billion in revenue, which would be good for a non-GAAP operating profit margin of 46%. Another attractive feature of this business being that it's a software business, generates very healthy operating profit margins. All right, so following these quarterly financial results, I updated my discounted cash flow valuation model for Adobe, which had the intrinsic value per share rising to $396 per share. Prior to these quarterly results, I had the intrinsic value per share calculated at around $390 per share. So there was an increase of about $6 per share following these quarterly financial results. The current market price is $349. So even after accounting for a margin of safety, this stock looks undervalued when measuring on my DCF basis. Furthermore, when we go to Fiscal.ai, which is my preferred data provider, there's a link in the description for their services if you're interested. And I retrieved the forward price to earnings ratio for Adobe. They're trading at a forward PE of 15.34, which also looks undervalued. So whether I measure the valuation on my DCF basis or whether I measure it on a forward price to earnings basis, I'm coming to the same conclusion that this stock is undervalued. So to update my recommendation for Adobe stock, I mentioned that I've had this stock rated as a buy for some time now. And following these quarterly financial results, I'm updating my buy recommendation for Adobe stock, letting investors know that at current market prices, I think this stock offers good risk versus reward for long-term investors. And of course, I mentioned the biggest risk right now is artificial intelligence is creating a possibility for new companies to come in with innovation that could steal market share away from Adobe. So that's the biggest risk here for Adobe, and that's why you're able to buy this stock at such a cheap valuation, because given its performance metric, a business like this would be selling at a much higher price. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.